Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Looking at this market, we can view the whole action from the heights of March all the way down until the May low as one large bearish halfway hesitation. It's one of the most gratifying moments in recent times to see prices drop down to reach the target and immediately shoot back up again. I mention this as it will become evident shortly. Anyway, the subsequent juddering rise in May pushed up through congestion and trend lines, plus the middle time, currently 1800, of the March to April bearish shift pitchfork. This pitchfork has, and still is, super significant, as it was the combination of the 50% Fibonacci line of the June to October 2018 move at 22.21 and the upper time, currently 2016, of this same March to April bearish shift pitchfork that capped the rise in late May / early June. And we subsequently saw prices move down and up and down, all the way down in between the middle time and the upper time. Now, during the move lower, the market created another, more recent pattern, another bearish halfway hesitation, a fresh one. The question was whether to measure from the May high at 23.33 or the April high at 24.88. Well, the May high gave us a target in the 1950 area, which had already been reached 4 weeks ago. Meanwhile, the April high gave a potential target X in the 1800 area. Last week on Thursday, with a combined bearish engulfing pattern and bearish opening long, really long, black Maribosa, the market dipped down to the target X area, and the very next day reverted back up again. Now you can remember, do you remember right at the start of this commentary I mentioned about how gratifying it was to see prices drop down to reach their target and immediately shoot back up again? Well, here it was happening again. The move up continued yesterday and only halted just short of the upper time. So what's next? Well, it's a bit early to say right now, but I will keep an eye on the upper time, as I suspect with so much activity close to it, it may be becoming vulnerable. But don't preempt it. The bearish shift pitchfork is still running in this market, and until it is properly broken, it will continue to do so. LME 3-month tin. The reactionary rise through May and into early June was muted. Prices managed to break the then March to date downtrend, but then failed to exploit the break, and by mid-June we had the consequences. The market reverted back down and carried on low until towards the end of June, when prices dipped heavily through constant congestion, notably the congestion band between the 22,900 to 24,155 levels. This one has some interesting supports within significant levels. They are the July 2014 high at 23,070, the May 2014 high at 23,500, the April 2014 high at 23,855, the October 2013 high at 23,970, and the March 2013 high at 24,155. The dip made that day penetrated all of these, but failed to break through the actual bottom of the support and instead reverted back up again. What was interesting about the move lower was how it was the first, and so far the only, market open below the middle time, currently at 25.10, of the rather acute bearish Andrews pitchfork for the mid-April to early June action that I'd drawn a few weeks ago. I'd previously said of this bearish pitchfork, and I quote, "It is very acute and therefore likely unsustainable, but it gives an idea of what we may be looking for on the downside." Thus, it seems an open below the middle time can cause such an action in this market. Now, I also posed a question a few weeks ago as to whether the action since mid-April was a possible bearish halfway hesitation. And the answer to that was yes. The downside target X for this move was in the 26,000 area, and it was reached, thus explaining the moves lower and the strong dip. But what about what's been happening since? And what may happen? Well, initially it looked like the market had gone roughly sideways with a bearish tinge, testing the congestion from February 2013 between 25,050 and 24,750. However, since then, the pattern has seemingly clarified into one or maybe more of the following patterns. a bear channel, currently 25,460 to 22,970. That could also be possibly seen as a bearish descending wedge pattern, or finally, a larger possible descending triangle as well. It is too early to say which it will be, but I will leave you with my oft-repeated words here when looking at the congestion support below and the bearish dangerous pitchfork. You see, early stroke to the middle next week, the upper time will meet the supports below. And I quote, "It will now depend on who wins between the heavy-duty supports and the bearish Andrews pitchfork." I guess it was always going to come to that. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investors International Limited. Here comes the final bit.